You're listening to the Real Estate Runway Podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today, we're going to bring my boy Matt Fore back on the show. This dude is an OG from back in early Real Estate Runway podcast episodes. So we're going to talk a little bit about how his portfolio has grown. He's now part of self-storage, car washes, apartments, all sorts of stuff. And so I'm excited to kind of have an operator-to-operator chat. And then we're going to get into the market a little bit and talk about what we're seeing as operators in the market. We're going to make some predictions, which you guys are more than welcome to listen to and tell us in 18 months how we were wrong or right. I'd love to hear that too. But before we do, if you get any value out of the show or any episode that we do, go ahead and leave us that 5-star review, subscribe to the channel, leave a comment, whatever you're listening to this on, just interact with the show. Share it with a friend. That's the only way you pay it forward and get to more people just like you. Folks, if you want to be on the show, you can apply at thequattroway.com/podcast. I love having conversations like these, and I welcome you to come on the show if you have value to bring to our listeners just like yourself. And social media, check us out at YouTube and TikTok at Real Estate Runway Podcast. You'll find a lot of shorts of these episodes and just little sound bites as well as the larger episodes in general. And folks, we're always working on projects. If you want to work with Quattro Capital, check us out at thequattroway.com/invest. And we would love to have a conversation with you. So without further ado, let's get right on to your featured presentation. All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway Podcast. I'm your host, Chad Sutton. This is your captain speaking today. Good to see you all again. Folks, I have one of the OGs from early Real Estate Runway, and I was actually a guest on his show, Ice Cream with Investors. Go check it out. All places podcasts are found. Matt Fore, welcome back to the show, brother. How you been in 2 years?
Thank you. I've been good because I think the last time we connected, the Vols were still a terrible football team, and the Tennessee Vols are primed and ready to take on this football season. So I'm very excited to see how they'll do this year.
Yes. Here now we're bantering just a minute ago. If you're a Tennessee fan out there, you know what I say, or you know what I mean when I say it feels like 98. So I think we're pretty excited to see the Big Orange kick off the football season here in just a couple of weeks. We're getting pretty close, aren't we?
Yep. 12 days or something like that.
The best time of the year is when those first crisp fall days come on game day Saturday. We're just like, yep, 72 degrees. It's time to watch the Big Orange do some damage. So.
You're missing one key fact, though. You got to have your pumpkin spice latte in hand.
That's it, dude. Oh, the good old PSL. Matt, remind us, folks, in the show notes, I'll go back and put what episode it was that Matt was on before. But for those who haven't listened to that episode yet, remind us who you are, how you got into the space, and maybe fill us in on what you've been doing over the last 2 years before we get into a conversation about what's going on in the real estate market today.
Sure. So high level, I've spent 15 years in technology and technology sales at some of the largest companies out there. My real estate journey began back in 2016 when I was part of a life-changing deal. We landed a $10 million net new logo. I was supposed to receive a life-changing commission check. And ultimately, I got the call from my VP at the time who said, hey, you're not going to get that check. You're only going to get 2 cents on the dollar. So it was through that exploration of how was I going to invest this money? I grew up in rural Appalachia, East Tennessee. So I never was into cars, watches, fancy houses, all that kind of stuff. So I was looking at different ways how to invest that money and ultimately landed on real estate, appreciation, cash flow, tax benefits. It checked all my buckets. And I remember getting that call and I was pretty frustrated for a very long time about not getting that money. But ultimately, it led me down a fantastic rabbit hole that's given me a lot of passion and energy about my financial future as well as others that I know. Done everything from single family investing, fix and flips. Our portfolio today is now 4,000 apartment units, 12 self-storage facilities, 30 car washes, 5 mobile home parks, and a partridge in a pear tree. So that's a little bit about me and what I do over here.
I love it, brother. And you mentioned a couple of different asset classes there, though. In your experience to date, I know you've got multifamily under the belt. We've talked about that before. When did y'all decide to venture into the other asset classes? And what drove that decision for you?
Yeah, it was a search for yield. So that's the long story short, was a search for yield. We started off into the self-storage space and continue to operate there. But a huge focus of ours right now has been car washes. And I'm happy to go into it further, but ultimately, you probably know Shaquille O'Neal. A lot of people know Shaquille O'Neal. That dude owns 154 car washes. So a lot of us got scratching our heads saying, I think he might know a thing or two about cash flow and assets. And that turned us onto that space. And man, it's been a fantastic little niche for us to continue to grow in.
I love that, dude. You know, I love talking about cash flow and yield. And so let's actually get into it a little bit before we get to the macro level market in general. So you come from the multifamily operating space. And I think everyone on this show, we've talked about that enough here where you realize that operations stems from whatever your team as the owner will do from an asset management perspective, and property management, which is usually a third party firm, can be insourced, but all the overhead that goes with that. But talk to me a little bit about how you operate your self-storage and car wash assets. I'd venture to say there's not as many just third-party management companies you can go to, so you've probably had to build out some infrastructure. Let's go through how you guys became an expert in that before we move on.
Yeah, that's it. So we do third-party management on all of our multifamily. But with the self-storage and the car washes, ultimately, we had to build some of those capabilities in-house, because when you're out there looking for management companies around those spaces, there's just not a lot. A lot of mom and pop operators, a lot of people who have maybe 3 or 4 facilities or 3 or 4 locations from a car wash perspective, but none really operating at scale. First is we decided to create our own little management company that would go manage our car wash locations and our self-storage facilities. But why we were interested in the car wash space is, one, I mentioned it just prints cash, right? Those things typically operate at a 60% profit margins before debt service. Automatically from the get-go, they print cash. The second reason we got interested in those is because the tax benefits. First and foremost, I'm not a CPA. Don't sue me. I'm just a guy on the internet. And I'll tell you a little bit about what our CPAs told me, but I'm not the person that you should go to for this advice. But
if you stay till the end, I will give you his home address. You can go find him if he's wrong. Okay.
That's right. That's right. But the tunnels themselves, what we found interesting about this space is the tunnels themselves can be depreciated on a 15-year timescale versus a traditional 27 and a half or 39 and a half, like you see in multifamily and office and things like that. So we're seeing huge tax benefits on it. So one, it cash flows. Two, it has tax benefits. The last thing that really interests us about this space is how fragmented it was. Chad, when you think car wash, you typically think, what's the one closest to my house? But that's not a name brand, right? And when you look at the car wash market, the number one operator of car washes owns 4% of the market share. And when I say toothpaste, you think Colgate Crest. When I say soda, you think Coke Pepsi. But when I say car wash, it's usually the one around the corner. So ultimately, our asymmetric bet in this space is we're going to grow to 100 locations. And at 100 locations, we'll be a top 10 provider of car washes in the country. And at that point, we put ourselves in the great position to either go get acquired and have a demand a high exit multiple, or go try to make the acquisitions and be the consolidator ourselves. So a lot of different exit strategies and a lot of different good opportunities in that space.
Yeah. And private equity is super interested in general. So this isn't really real estate or hedge funds on that side. I'm thinking like private equity funds, super interested in cash flowing portfolios of things that they can't really get anywhere else. And what you think about big money, what they don't have the energy to do is what Matt and his team are doing is let's go pick up the mom and pops and go through the headache of getting them assimilated into the culture of the portfolio and of the brand. They want to just buy a thing that works and is easy and can print money, whether Matt is controlling it or not. And so that's an incredible business opportunity that is car washes. And so if you don't mind, I'd love to ask a couple more questions on this because just out of my interest, I'm sure everyone else will have it as well.
Yep. Hit me with them.
Yeah, dude. And you mentioned the tax benefits. So 15-year depreciation schedule. Do you typically cost seg these as well, or is it not really applicable in this space? You do. So you can.
Yeah, you can cost it. Yeah, so you can bonus depreciate and accelerate depreciate the tunnels themselves. Obviously, the land you can't. But so when we see that, what that means to an investor is on a K1 last year, we saw typically around 75% K1 loss in year one, which is a huge tax benefit.
Yeah.
Yep. Now, obviously, we stepped down this year, so we're going to see what that looks like, but we're still projecting in that 60 to 75% time range.
That's very good. And folks, what he just told me, that gave him a lot of credibility in my eyes, and I'm going to tell you why. There's a lot of operators out there who are claiming 100 or more % of bonus depreciation. And folks, there's very few instances where that's actually true when it gets to you. So Be careful if you're being offered that because it probably isn't going to be that way for you. But what I know is multifamily, depending on if I close at the beginning of the year or the end of the year, if it's towards the beginning and I have operating losses, you're usually getting to around 50% of the loss ratio. In some cases more. It's always dependent on the engineering study, but you're right. The car washes, they do have the ability to, with the shorter timetable and a little bit different engineering makeup, there's a little bit more ability to increase that depreciation to the investor, which is fantastic. And so, Matt, I guess the next place I would go with it is when you're buying these things, are you leveraging them? Are you buying them in all cash and the multiple's that good that you cash out later? How are you structuring these deals in the car wash
So
industry?
we structure them with leverage. I do know operators out there who will buy 1 or 2 or 3 locations, and they might be like the self-service car washes, and they'll go buy them with cash because they're so cheap. But ultimately, we're buying nicer locations, newer build, path of progress, express bay tunnels. So the 130 foot, 120 foot long tunnels out there that you see. And it makes sense for us to go leverage on that sense.
Yeah, that makes a lot of sense. And I guess the third question that I've got is I've heard of some groups actually having to put a chemist or a scientist on staff per se. Now, these are guys who are like re-engineering the tunnels, right? Do you have to get into that world to play in car washes? And do you see that as a risk?
You don't. We have somebody who has spent over a decade in manufacturing in the healthcare space and in the auto space. And so what makes him the golden goose for us is that he spent time in both worlds, both the auto and the chemistry aspect of it. This guy knows things down to, hey, if we move the nozzle on this specific spigot like 2 degrees, we can actually save this much on our water reclamation and things like that. So it certainly helps, but I don't think it's rocket science. I think sometimes we can just go out there and figure it out on our own. And if you're looking at this space, it's not rocket science once you figure it out.
Yeah, that is fantastic. And elevating from this a little bit. So we've got a guy here who is playing in multifamily operation, self-storage operation, which is very similar in that it's still unit-based, folks, but a little different on the operational side and the longevity of tenants and things, but still very similar. And the car wash sides. And I assume, by the way, just one more question. Are you putting all those in the same fund, or do you have a multifamily fund or thing? Is it more like broken out asset class wise when you structure?
Yeah, so multifamily, we typically do 1-to-1. We have never done
Yeah.
a fund around multifamilies, meaning, hey, if you're an investor
Yeah.
out there, you're putting your dollar into this deal. With our car washes and our self-storage, we do it a little bit different. We are always underwriting and doing due diligence on a couple dozen locations at a time for both of those. So ultimately what we do is when we get something in the pipeline and through our due diligence, our rough sniff test on something, and we feel like we can close, I don't know, 2 to 8 locations at a time, we'll open up a fund, put those locations in the fund, raise the capital, close the deal, and move on, and then close that fund, and then open a new one. So that's how we've operated. So ultimately, our goal is to sell this off as a portfolio. So you'll get the benefit of all the other funds because we can demand a higher multiple with all the locations we have, but you are investing in a certain amount of locations per, basically.
Yeah, that makes sense. And my only reason to ask that is some of those investments can offset one another. Sometimes I've seen people put them all in one fund, but inevitably you get more of the market who just can't get their head around like a car wash and a self-storage and a multifamily at the same time. It's like it's too much. So totally get that. Let's elevate a little bit, Matt. Let's talk about just what are you guys seeing in the market today? And I'm gonna candidly say this, folks. If you're out there, unless you're living under a rock, there's bad press in real estate right now in general. And the bad press is typically centered around loan problems and office problems and layoffs that really aren't happening that much. And not just office, but some retail. People are worried about retail ownership if we're going into a recession and the Amazonification of things and all that. But I'm just curious, you're operating 3 major asset classes. You're still acquiring, you're still selling. What are you seeing out there today? And what risks do the investors need to be thinking about as they're looking for yield today, or even on the investments they're currently in? What do they need to be asking their operators to make sure that things are okay?
Yeah, so I'll take that from a couple different angles. First of all, if you are already invested with an operator, the number one thing I would be asking right now is what does your cash reserve position look like? So I will be transparent and say that we have had a couple of our deals where we've had to pause distributions for 2 quarters. We will restart them in October going into the back half of the year, but we had to pause distributions. And ultimately, some investors were upset with that. And it's, hey, Chad, I can send you $1 today, but I might have to do a capital call and ask for $2 later if something catastrophic happens on this property, a fire, a hurricane, a tornado, something like that. So we had to go through those difficult times and we're weathering through those. But ultimately, that's the first thing I would say is, what is your cash position? And we run a tendency of over raising to keep a healthy cash position. I don't think a lot of operators did that in 2020. I think they were paying distributions all along to say, hey, we'll wait until we get cash flow positive. Interest rates spike. They didn't have a cap. And now all of a sudden they're underwater and they've paid out all their cash reserves. We went a little bit more conservative. So that's one thing I would look at if you are in deals. In terms of what we're seeing, multifamily is slow right now, specifically. And my assumption
slow in what way, Matt? Slow in what way?
Transactions more than anything. What I see is that there's a lot of folks out there who bought these properties in 2017, 18, 2020 or whatever. They saw the run up in pricing when interest rates were 2.25%, and they're still anchored to that price. And so I think there's a lot of operators right now that say, hey, I got another 6 months, year on my maturity on this loan. I'm going to hold and see what happens in the market and hope that somebody will come in at a higher price than what it is. So that's what we're seeing on the multifamily side in terms of transactions. The last thing I'll say is on the debt side, we've seen more LTV requirements than in the past. It used to be in 2020 and 2021, you could get up to 80, 85, 90% LTVs. We're seeing those back down a ton. And then ultimately the debt coverage ratio, they want to see healthier than they have in the past. So going in, they want to see that 1.25, 1.5, not a plan to get there, but already at the beginning. So those are just a couple things that we're seeing in the market right now, and happy to talk through any more of those that you want.
Yeah, I love what you said. And so just questions that investors should be asking their operators. And what Matt said is brilliant. Cash is important. And I say this all the time on the show, folks. You only get in trouble, and this is any kind of real estate. This is not multifamily or self-storage or anything. It's anything project-wise. You only get in trouble if you run out of time or you run out of money. And so the two things to be asking you, it all boils down to those two things, right? Matt's shaking his head laughing. I think he's realizing it. It's when you really think about it, if you have enough money in the bank, but you can withstand a big insurance claim or a big catastrophic failure of a boiler or a little time of negative cash flow when rates spike, if you have that, right? Or you can support having to buy an extra rate cap to extend your loan or an extension fee or something like that. It's when you don't have cash and you're running about that slim that if the wind blows and all of a sudden you're out of money, if you don't have money, you're technically bankrupt. And so you have to raise money to put more money in. And that means coming from investors or the sponsors. So that's not a good situation. Focus on keeping your cash flush. Operators out there, like you heard Matt say it, we do the same thing. We will intentionally raise this because I don't trust anything being in place the day I buy it. I want to prove that out first. We'll raise a working capital reserve. We'll raise an operating reserve, all that kind of stuff, because there's things that are going to go wrong. You're going to need more money than you think. The other side, and the thing that I would tell you to make sure you're asking your operators is, what loan maturities do we have coming up? And if we have loan maturities coming up, what extension options do we have? Do we have to buy another rate cap? What fees are involved? And are we in a good position to take it to a permanent loan? And here's the thing, folks, bridge loans are not bad. Short-term debt is not bad. What is bad is when you have short-term debt, your NOI may not be on schedule or ahead of schedule, and you're at a time where you have to make a capital decision. You have to choose to refinance the project. If you don't have enough cash flow to refinance the project, then you're either going to refinance where you can and put more cash in, which means capital call from investors, or you will be selling the project at whatever the market will bear at that time. So I think that those two questions, and it all comes down to time or money. Mr. Operator, so if you're an investor, Mr. Operator, am I out of time or am I out of money? Do you have anything to add to that, Matt, or did I boil it down to those two?
I was smiling and shaking my head vigorously because controversial opinion, I think the only way you ever really truly lose money in real estate is if you run out of time, meaning you are forced to sell. meaning some sort of expiration date happens. Because almost anything else you can weather. Now, are there bad deals? Of course, there are bad deals. Will things happen? Of course, there will be. Are there times in the market where pricing comes down? Of course, there is. But 100 years from now, if I buy a multifamily today, 100 years from now, I'm almost guaranteed that it will be worth more than I bought it for, just due to inflation more than anything. So if you can hold real estate, it will almost always go up and to the right. So I was shaking my head vigorously around the time aspect there.
You may have just blown up my thing here, because that is, you're right. It really does boil down to time, because what does money buy you? Money will buy you time. If you're out of money, you're out of time because you don't have money to keep going. So that's a very interesting perspective. I may have to go back to the drawing board on that, Matt.
Nectar understands that raising capital is labor and time intensive, and we exist to solve that problem for you. Nectar provides fast, flexible, cash flow-based financing for experienced rental owners and operators. Whether you need cash for acquiring properties, portfolios, or you simply need it for ROI-generating renovations or expansion of staff, Nectar has your back. Grab your 12-month P&L with debt service and click the link in the show notes below to apply today.
So that's great. So let's talk a little bit more about, you're right, multifamily transactions are slow. I would venture to say, you can tell me this, but are transactions in your other sectors slow as well, or are they still moving pretty good?
Yeah, I think self-storage has almost come to a halt, is what we've seen as well. There's been a lot of supply come onto the market, specifically in a lot of certain markets that we've been playing in over the past 5 years, let's call it, since 2020, 2017-ish. So we haven't done anything we've done one self-storage deal this year. We have done 0 multifamily this year. And the only deal that we're under contract for, we had to put it in a tax abatement program to make it kind of work. And because of that, it's a fantastic deal because of that. But ultimately, you're not going to find, I think, deals from a multifamily standpoint that pencil unless you have some sort of other value drive adder that you can add to it. So I don't know, but that's probably the only thing I'd say around those.
Yeah, that makes a lot of sense. And let's talk about why that is, folks. As we sit today, it's late August 2023. We've now endured about 18 months of interest rates running up. I think we may still get one more hike this year. The jury's still out on that. The Fed doesn't even know. But when you think about it, your long-term debt, and I'm going to talk multifamily for a second, just because a lot of people know that, your long-term agency debt is about 6%, give or take. Some properties are lower, some are higher, but it's about 6%, 6.5% if you're on a smaller asset. Look, cap rates are just now they are decompressing. The prices are going down. It is slowly happening. Rates ran up real fast and prices are slowly coming down. Cap rates are slowly coming up as some people have to start trading today. It is happening. I think as of this recording, we're probably at 5.5 on the average cap rate for a decent deal. So the problem there is if you have interest rates at 6 or 6.5 and cap rates at 5.5, maybe 6, you're still at the point where the interest rate is too expensive for the cap rate you're buying the project at. And so that for that reason, buyers are trying to push cap rates north of 6. Sellers are trying to hold on to that mid to low 5 as much as they can, if nothing else, than just to get out of what they had from before. And that makes it challenging. I'm curious, Matt, what are your thoughts on, and let me make a premonition real quick. As we see that coming, right? And I love getting on a soapbox and being wrong. So if I'm wrong, y'all can come remind me of this in 12 months. We saw the interest rate spike. That curve went up real fast. Prices are coming up slower. The Fed is signaling that they're probably at the top. And I think the health of the banking system tells us we're probably at the top of the interest rate hikes, because if we go too much farther, we're going to really have a banking crisis on our hands. And it's debatable whether or not that's what the Fed wants. We'll see. But if you think about the fact that we're probably going to pause at peak rates while prices continue to decompress a little bit, then you're probably going to start to see things roll back. And this is where I know Matt's got some commentary. We're going into an election year in 2024. So figure we may ride interest rates up high for where they are for the rest of this year, but there's going to be some political pressures, if nothing else, from constituents who own real estate and are probably feeling some pain right now before that election cycle comes. So it's highly likely we will see rates start to come back to whatever our new level will be, new normal will be, probably not 3%. And it'll probably intersect that line of cap rates that are decompressing on its way down. And that's where deals are going to start to be had again. So that's what I think is going on, Matt. What are your thoughts on today and going forward? What do you think?
Yeah, I I want to say two things. One, on cap rates. So we made a bet back in 2020 on cap rate suppressions. What we saw is that cap rates in the C class assets were compressing faster than in the A class. So what does that mean? What typically a C class asset might trade at an 8 to a 10 cap was all of a sudden trading for a 5, 5.5, 6. Yeah. The level to which it had compressed was tremendous, 400 bips, let's call it. If you look at the A class, what we saw was in our metro areas that we operate in, they went from a 4.5 to maybe a 4.25 down to 4. So they fell 50 bips, right? So the overall compression or expansion back to the mean, we made the bet that in A class, it wouldn't expand too far past the mean of that 4.5. So we only had 50 basis points to go. Whereas in the C class, if you bought an asset in a C class that was a value add at 6 cap and it expanded back to a 10 cap, you are in a lot of trouble. So we shifted our portfolio back in 2020 to not the 1960s, 1970s value add properties of the C class where there was a lot of meat on the bone. We went to an A class lease up strategy and things like that. Now, that has fared well for our portfolio up until this point. And I think it will continue to fare because of your second point around interest rates. What do I think about interest rates? The way I view interest rates right now is that you said a couple of things. One, the Fed probably will hike again at the end of the year. I think that's almost a guarantee personally. But I do think when you look at 2024 and 2025, we have something like $7 trillion of real estate loans that will expire during those 2 years. And we're going into an election and liquidity has dried up from the system. My personal belief is that someone in Washington will intervene to find a way to make that refinancing of those loans a lot more palatable. Now, that could be the Fed pushing down rates. It could be some program we've never even heard of. But if you think about it, there's two levers they can really pull. There's the Fed lowering the interest rates or something around interest rate lever, or the tax lever. And what we've seen is that 100% bonus depreciation in 2022, we've stepped down in 2023, we will step down again in 2024 by just simply revitalizing that rule or making something like a 1031 exchange an easier process. I don't know what that looks like. I'm not smart enough to know that and how they could structure that into law. Would also increase volume into the system and help smooth out these choppy waters that we're seeing. So going into next year, I think that's the thing I'm looking at is one, what is the Fed going to do with rates? Are there levers that they can pull with Fannie and Freddie or the agencies to make some sort of differently structured product to lower interest rates for just real estate? Or do we look at some sort of tax law to kick back in 100% bonus depreciation like in the Jobs Act or some sort of lever around there?
Yeah, that makes perfect sense. And let's give an example. And I'm trying to remember what caused this, but in the recent past, the Washington actually did push a directive that caused the agencies, Fannie or Freddie, to start offering 35-year amortization instead of 30. And what does that do? It doesn't change your interest rate. What it does is it says, okay, when you start amortizing, your payment's going to be lower because we're spreading it out over 35 years instead of 30 years. And so there's little knobs and switches like that Matt's talking about. And it all goes down to motivation, right? It is a good thing that we've had this battle now, and that on the tail end of it, there are politically driven agendas that are going to desire to either have some party show that they had a miraculous turnaround or be able to point blame at the other. And none of that gets accomplished if the world is in turmoil during an election year. And so it's going to be very interesting to see where we go. But I think, Matt, we've also seen the banking system learn a lesson or two, right? The Great Recession, it's been a while, right? But it's not been that far, that long since 2008, to be fair. And so in recent memory, let's just unpack what happened there again for a second. I'm not going to get into the subprime mortgages and all that kind of stuff and what caused it, but a big reason it blew up was because when these loans started getting upside down, they were triggering due on sale clauses or other terms of the like, and lenders started pouncing and aggressively foreclosing on properties where loans were out of compliance. And what happened? That turned lenders' balance sheets to mush, and we had major bank failures and a global economic meltdown over that loss of wealth. And so I think, yes, we have $7 trillion in loans over the next 2 years. You're right on that number. It's a very big number, staggering. And I think we're all affected by that over the next 2 years. And so what good would it do to allow that to happen and allow lenders to just start taking prey on everyone? And why would the lenders want to do that? Their balance sheets are already in trouble as we speak today. They don't want those assets back because in some cases, think about it. If you're a lender, Matt, and you made a loan, like you said, on a Class C asset that maybe someone paid a 4.5 cap for a 60s asset and had this great value add plan. Well, look, they may be a great operator and they may be executing on that plan 150% and getting rents to up $300 and all this kind of stuff. But I'm here to tell you, if that cap rate, that cap rate due to the interest rates rising up to 6 or 7%, if that cap rate is now north of 6% and they bought at 4.5, they're still in trouble. And if that lender takes that asset back, they still don't have 1-to-1 on their value for the money they have lent out on it. So you start to see the big problem we're in, where something's got to give or nobody wins. You know what I'm saying?
Yeah. I think your commentary around the 35 and 40-year mortgages, like that's where my head goes.
Yeah.
The thing that we should have done in 2020 and 2021 is break this conventional model of a 30-year T-bill, a 30-year treasury bill, and gone 100 years. Can you imagine if we would have structured all of the money we printed in 2020 through 2022 and put them on 100-year notes versus 30-year note? Of course, yes, you're going to pay more interest over time, but your payments are smaller, thus giving you a lot more liquidity and cash flow through your system. So I think when I talk about creative programs that help lower your interest rate, you make a better point there around how do you lower the payment? And you can do that by extending the terms. And if you extend the terms, obviously now we can refinance and be in a smoother place, I think.
Yeah. I think however they do it, I think we both agree if it comes down to time is what everybody needs, we're going to have to find a way to get time. And so if there are loans that are on the verge of failing just because of a maturity at a bad time, that's all it is. Again, every project we have is executing well, and most of our stuff is fixed rate, so we're in pretty good shape, but we do have a handful of floating stuff. Now, we were smart. We put an interest rate cap on it, a pretty low one. People thought I was crazy for buying 1% strike rate caps, but who's laughing now? And so that was good. But think about it. The only problem we have, we're hitting pro formas or exceeding pro formas. We're operating well. The rate cap's in place. The only thing keeping me up at night is I've either got to buy a new rate cap next year and qualify for an extension or refinance. And I'm like, shoot, where are they going to be?
Yep.
So that's the problem that I think everyone is facing. And there could even be long-term maturities, because there are long-term maturities coming due in the CMBS market. So it'll be very interesting to see where we go. As it is, operators like Matt and myself will have our ear to the ground to be bringing you news and updates in the market as we see them. But Matt, we're coming to the end of our time. What are some words of encouragement that you might want to leave the listeners with, and anything to keep looking forward?
I'll take it from the book, A Simple Path to Wealth. Jim Collins writes in that book, he's basically, every generation has their times of turmoil where you think the world's going to end. And he goes through this. What if I told you that our greatest enemy was launching satellites into space when we couldn't even get off the ground, and had more nuclear weapons, and presidents were assassinated, and people trying to run for president were assassinated, and civil rights leaders were assassinated, and your friends went to war and none, like half of them came back, all that kind of stuff. You'd have been like, wow, that's crazy. How'd you live through that time? And then what if I told you that the market outperformed and doubled during that time? So I know things feel aggressive right now. I know things feel choppy, but humans, let alone specifically Americans, have always found a better future to create, and have always been, when their backs up against the wall, found good situations, good resolutions to the situation. So that's the only thing that I keep thinking about is there's a lot of talk right now around de-dollarization and China's going to rule the world and all this kind of stuff. And I was laughing with an investor today. I'm like, people don't realize if we de-dollarize this whole entire economy, you're not going to be worried about a multifamily property. You've got much bigger problems to worry about at that point. So I would encourage everybody to always remember that life expectancies are up, health is up, literature levels are up. Wealth is at an all-time high. There's so many good things, but don't be sucked into listening to the clickbait news of Hurricane Hillary going to hit California and wipe it off the map and things like that.
I love that. You're right. News is made for ratings, not for educating you. So remember that, folks. Just to stack on what Matt is saying there, I will always bet on the U.S. economy and the U.S. people, always. We have shown through thick and thin that we always find a way, we always innovate. And look, I've been following that whole BRICS thing, talking about some major countries coming together and challenging the dollar. Look, the same reason the euro fell apart is why that falls apart. Which one of those countries are you going to bet on, right? You can't bet on the Chinese yen because of currency control. And it's like, why did the euro fail? It was, you come down to it, like, it's almost like saying you have 5 siblings, right? And your parents are going to give you all the same credit card, except you all have to pay for that credit card together, and your credit all gets hit the same if you misuse that credit card. How would you feel if you're the responsible child and 2 of the other children are out running up the bar at the car, or the card at the bar, and don't pay their bills? That's the same reason that BRICS will fail. It's the same reason that the euro failed. And it's just like, always bet on the U.S. economy, folks. We are in a great place. It's why people invest in our real estate all over the world. This has been the Real Estate Runway Podcast. Matt, good to have you on, brother. Let's do this again soon.
Yep. Appreciate it.
Do you manage multiple legal entities? Is your data scattered across various unsecure systems? Is your team spending too much time on manual processes? Do you struggle to meet reporting deadlines? Simplify entity management and compliance with Entity Keeper. Entity Keeper helps easily manage entities, build and maintain complex organizational charts, and track filing deadlines, all in one secure, cloud-based platform. And with automated alerts and centralized document storage, you'll stay 2 steps ahead of compliance deadlines. Click the link in the show notes to learn more and book a demo.
All right, Real Estate Runway, I hope you enjoyed that episode as much as I did. I love conversations where we can get philosophical and predict and just talk about all the stuff that's going to change and what's happening right now. I hope you enjoyed that episode with Matt. If you got any value out of the show, folks, please like us, subscribe, share it with a friend, write a review, do whatever you do to interact with the show wherever you're listening to it, as it's the only way we grow and get to more people just like you. So pay it forward. Love to have you on the show. If you want to check us out at thequattroway.com/podcast, you can apply. And we are always having offerings for investors out there. Check us out at thequattroway.com/invest to apply and see if we are right for you. Without further ado, we're going to conclude the episode today. This has been another episode of the Real Estate Runway Podcast, folks. Until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.